Are you looking for higher yields than residential real estate? Does a NOI yield of 6 to 10% appeal to you? The answer is simple. Understand commercial real estate. But first, know why beginners fail. Why is that a problem? This slide explains it all. Commercial real estate has several major sectors: office, retail, industrial, and multifamily of 5 units or more. Hotels, medical facilities, self-storage, and data centers are also significant sectors. Every one of them operates under fundamentally different rules than residential investing. The valuation methods are different. The financing structure is different. The nature of risk is different. And that NOI yield of 6 to 10% is nothing more than a rough benchmark for surface-level NOI returns. Actual total returns vary significantly based on rent growth, vacancy rates, capital expenditures, and final sale price. This is a structure proven by decades of commercial real estate markets. This is not theory. These are the established rules of the game, and this game is within reach. But there are conditions. Build your experience in residential investing first. Fully understand the numbers before you enter. This will change how you make decisions. Today, let me show you the evidence-based case. First, let's define exactly what commercial real estate means. Sector 1. Office. Corporations become tenants, signing long-term leases of 5 to 10 years. It looks stable, but right now it's taking a direct hit from the structural shift toward remote work. According to Moody's Analytics data, the national office vacancy rate in 2024 hit approximately 20%, the worst on record. And as JLL points out, older Class B and Class C buildings are taking a particularly severe blow. This is not a temporary trend. This is a structural shift in how people work. Sector 2. Retail. Restaurants, shopping centers, retail stores, directly tied to economic condition. And the rise of e-commerce continues to squeeze brick-and-mortar operations. Sector 3. Industrial. Warehouses, logistics centers, manufacturing facilities. E-commerce growth has been driving demand for industrial real estate. However, from 2023 through 2025, a construction boom has pushed vacancy rates higher in certain markets due to oversupply. As Cushman and Wakefield data shows, the one-sided tailwind of the past is beginning to fade. Sector 4. Multifamily of 5 units or more. Generally, 1 to 4 units fall under residential mortgage territory, while apartment buildings of 5 or more units are typically handled under commercial financing and appraisal frameworks. They carry the stable demand of residential while operating under commercial real estate valuation rules. This makes them an accessible entry point that bridges residential investing into commercial. Saying you want to invest in commercial real estate without understanding these 4 sectors is like saying you want to play sports. Baseball, soccer, or basketball. The skills required are completely different depending on which game you're playing. This is the most fundamental difference from residential investing. How is residential property value determined? Comparable sales in the area. The house next door sold for $500,000, so mine must be worth $500,000 too. Emotion and market psychology drive pricing. Commercial real estate is driven by income. As the Appraisal Institute and RICS demonstrate, real-world practice involves verifying consistency across multiple valuation methods. The first method, direct cap. Divide NOI by cap rate. This produces an estimated property value. If annual NOI is $120,000 and the cap rate is 6%, the property value is $2 million. The second method, DCF. Discount projected cash flows across multiple future years back to present value. For properties with long-term leases or rent fluctuations, DCF more accurately reflects reality. The third method, sales comparison. Verify consistency against the sale prices of comparable properties. And in loan underwriting, additional metrics come into play. DSCR, the debt service coverage ratio. LTV, the loan-to-value ratio. And debt yield. These determine whether financing gets approved. Do you see the critical pattern here? When NOI drops, every single number deteriorates. The moment a tenant vacates, both the property's valuation and its financing terms can collapse at once. This is the ruthless rule of commercial real estate. You need to understand cap rate one level deeper. You often hear that New York and San Francisco have low cap rates. At one point, office and high-quality multifamily properties in those markets saw cap rates as low as 4% to 5%. But now, that assumption is breaking down. Why? Interest rates. What happens when you buy a property with a cap rate of 4% to 5% in an environment where borrowing costs exceed 6% to 7%? The cost of your loan exceeds the property's NOI yield. This is called negative leverage. Your cash flow goes negative. You bought what looked like a quality asset, and now you're losing money every month. As CBRE's H2 2024 cap rate survey shows, cap rates are not determined by city alone. Sector, property quality, lease terms, and the interest rate environment. These factors combine to determine the cap rate. Even within the same city, the range for industrial versus office can be completely different. What's even more important, cap rate is simply a benchmark for NOI yield. True investment returns are measured by IRR, internal rate of return, and equity multiple. Rent growth, vacancy periods, capital expenditures, and final sale price. All of these determine total return. There are countless cases of beginners who, judged by surface numbers, failed to recognize negative leverage, bought properties, and spent months bleeding cash every month. To talk about commercial real estate, you must understand triple net lease. NNN lease, for short. This is the core of commercial real estate. Think about a typical residential rental. As the owner, you pay property taxes. You pay insurance. You pay repair costs. NNN leases operate differently. Each of the three N's stands for net. The tenant pays property taxes. The tenant pays insurance. The tenant pays CAM, common area maintenance. Once a quality tenant is in place, you can expect stable cash flow for 5 to 15 years. But there's a critical warning. As the ICSC 2024 report makes clear, even in NNN leases, many contracts leave the owner responsible for roofing, structural components, and capital expenditures. Zero cost is an exaggeration. You must scrutinize every clause in the contract. And when a tenant vacates, the loss goes far beyond a simple rent calculation. It's not just the missing rent. There's TI tenant improvement costs to attract a new tenant, build-out expenses, leasing commissions to brokers. And it's not uncommon to offer free rent periods, months of no rent after move-in. During vacancy, the NNN structure reverses. Taxes, insurance, and maintenance all fall back on the owner. As NAIOP's 2024 research shows, the cost of releasing a commercial property beyond lost rent is substantial. This is the double-edged sword of commercial real estate. So why is commercial real estate not suited for beginners? Let me explain with 4 risks. Risk 1, economic sensitivity. When the economy weakens, corporations downsize their office space. Retail stores close. As Green Street data and others show, during the financial crisis, commercial real estate prices fell 35% to over 40% from peak to trough. That far exceeded the decline in residential values. The magnitude of decline varies significantly by sector and region, but the numbers are devastating across the board. Risk 2, single tenant dependency. With 10 residential units, one vacancy means a 10% impact. But in a commercial property, it's not uncommon for a single tenant to account for over 80% of revenue. What happens when that tenant leaves? Think about it. Risk 3, structural disruption in office. According to Moody's Analytics, the national office vacancy rate in 2024 hit approximately 20%, the worst ever recorded. And as JLL reports, older Class B and Class C buildings are taking an especially severe hit, accelerating the quote to quality toward premium new construction. Risk 4, the maturity wall. This is the most dangerous risk right now. As Mortgage Bankers Association 2024 data shows, an enormous volume of commercial real estate loans are coming due between 2024 and 2026. The problem is refinancing in a high-rate environment. Even when a property's NOI is holding steady, the new loan terms may be too restrictive to refinance. Your only options become injecting additional equity, selling the property, or in the worst case, defaulting. The IMF's April 2024 Global Financial Stability Report explicitly identified this as a primary risk. Even with no vacancies, a loan maturity alone can destroy you. This is the reality of commercial real estate today. So if you're actually going to enter commercial real estate, what do you need? Let's talk numbers. Say you're buying a $2 million commercial property. That's considered small scale in the commercial real estate world. Down payments vary by property, borrower, and lender, but 25% to 35% is the typical range. At 25%, that's $500,000. At 35%, that's $700,000. As the Federal Reserve's Senior Loan Officer Opinion Survey from October 2024 shows, lending standards have been tightening in recent years, and conditions tend to be even more conservative. Compare that to residential investing. But to make an accurate comparison, you need to think in terms of investment properties, not owner-occupied. Even for 1 to 4 unit investment property mortgages, a 20% to 25% down payment is typical. Commercial real estate financing is still more demanding than that. The underwriting criteria are also different. For commercial loans, DSCR, debt service coverage ratio, LTV, and debt yield. As OCC and MBA guidelines make clear, the core of underwriting is whether the property can generate cash flow on its own. On top of that, there are due diligence costs. Phase 1 ESA, Environmental Site Assessment, as defined by the EPA, and PCA, Property Condition Assessment. These must be completed before you buy any commercial property. Costs vary by size and use, but 1% to 3% of purchase price is the benchmark. On a $2 million property, that's $20,000 to $60,000. And this is money spent before you even take ownership. Here's the bottom line. You cannot enter commercial real estate without capital. But capital alone is not enough reason to enter. So what is the right roadmap for entering commercial real estate? Experience. That is the only passport. Step 1. Master the fundamentals with 1 to 2 residential properties. What is cash flow management? What does dealing with tenants actually look like? Learn the reality of property management through direct experience. Step 2. Scale to multifamily of 2 to 4 units. Build experience managing multiple tenants simultaneously. Learn the impact of vacancy at a manageable scale. Step 3. Move up to multifamily of 5 units or more. This is where you enter the commercial financing framework. Get experience being evaluated on DSCR and LTV. Develop your eye for properties through the NOI, divided by cap rate lens. But your property scale is still manageable. If you make mistakes here, the damage is still controllable. Step 4. With that experience in hand, move into full-scale commercial real estate. Office, industrial, retail, or large-scale multifamily. By the time you get here, you are not a beginner. Why does this sequence matter? Failure in commercial real estate operates at a completely different scale than failure in residential. A residential vacancy might cost you $2,000 a month. A commercial vacancy could cost you $50,000 a month. Add to that the NNN reversal, TI costs, and leasing commissions. The same mistake hits at an entirely different magnitude. You can do this. But building in the right sequence is non-negotiable. Commercial real estate is the major leagues. You cannot step onto that field without time in the minors. Now let's lock in today's key takeaways. Here's your summary. First, commercial real estate is a completely different game. Income drives property value. The direct cap of NOI divided by cap rate anchors the analysis, cross-checked against DCF and comparable transactions. A multi-lens approach is the professional standard. Loan underwriting demands DSCR, LTV, and debt yield. And cap rate is nothing more than a benchmark for NOI yield. When the spread between borrowing costs and cap rate turns negative, even a quality property produces negative cash flow. Second, right now is a particularly dangerous moment. Moody's Analytics data shows the national office vacancy rate hit approximately 20%, the worst on record. And then there's the maturity wall. As MBA 2024 data shows, massive volumes of CRE loans are coming due in a high-rate environment. Even without vacancies, the risk of collapse from refinancing a loan is very real. Third, the right sequence is the only answer. Start with residential, scale through multifamily, get your first taste of commercial financing at 5 units or more, then make your full entry. Many who skipped this sequence lost their assets when they faced the compounding risks of recession, vacancy, and refinancing difficulty at once. Where are you right now? Have you not yet tried residential investing? Or are you already generating returns through multifamily? Drop a comment and tell me what stage you're at. Your position right now becomes the map for this entire community. Thanks for investing your time with me today. This channel breaks down real estate investing, asset allocation, and the path to financial freedom, always through the lens of numbers and strategy. If you're looking to build wealth through data and design, not emotion, subscribe and turn on notifications so we can keep moving forward together. See you in the next one.